Good afternoon, everybody. My name is Ntuleng and I am one of the credit research analysts in the markets research team, and I'll be your moderator this afternoon. First and foremost, thank you so much for accepting our invite to part 2 of our two-part series on global macro. So we decided to break down this discussion that we've been having on global debt into two parts. And like I said, this is the second segment of our two-part series, where in the first segment, we just had a look at how we got to these high levels of unprecedented global debt. And now in the second segment, we're going to be having a look at how do we then go and deal with this all of this debt. So I encourage all of you guys to just stay engaged throughout the session. If you have any questions, any comments, you can use the chat box that is provided on there just to field your questions and your comments. Just some housekeeping. Please do note that our analysts, they are independent. So whatever view is shared by the analyst, it is that of the analyst, and it's not necessarily the official Nedbank view. And then secondly, I did mention that we have a chat box available that you can use throughout the chat. Yeah, let's get the show on the road. So today's speaker, he needs no introduction, but I'm gonna go ahead and introduce him anyway. This afternoon we have a very seasoned macro research analyst who has deep knowledge and understanding. And yeah, with that, ladies and gentlemen, join me as I welcome on our virtual stage Neels Heyneke. Neels, welcome.
Thank you, Ntuleng, and good afternoon to everybody listening. Yes, this is a very effective way to reach a lot of people, but I'm quite sure many of you, like myself, we've lost our appetite for Zooms and Microsoft Teams meetings and whatever, and I would love to do this rather in person than over this. But yes, as Ntuleng said, we're going to try and look into the future, what can potentially happen. The problem is nobody knows exactly what is going to happen. It's not like we can say in 1682, that happened and use it as an example, because the problem is over that period, this is the first time in history where we, in the middle of a serious debt crisis, off the gold standard with central banks, and we all are at this stage just trying to think out loud, how does this all play out? So I know we're on the right topic, because since we released the paper on this last week, Thursday, I've received a lot of interest from many different participants in the financial markets. I must say some of it borders on hate mail, because a lot of people are convinced that inflation is coming. But it actually concerns me in the sense that there are so many people sold on inflation is the way out. Inflation is not a silver bullet, and I will point it out as the presentation as we go through the presentation. Inflation is by no means the success story, because inflation is at the end of the day the ultimate tax on society. So if I can just ask the team to call up the first chart, please.
So Neels, just yes? before we get to that, do you mind giving a quick 2-minute recap on some of the key stuff that we shared the other time that will be important for the second segment?
Right, yeah, that's maybe a very good idea to start with that, Ntuleng. Yes, so what we pointed out in the previous time, so the world has gone through, the monetary system has gone through some major changes over the last 100 years. So we had inflation and deflationary cycles. Every 23 years, we had basically a control-alt-delete on the system, on the financial system, and we would write off all the bad loans in the system. And that absolute contraction, that would lead, if you go through that whole insolvency cycle, would lead to a massive deflationary bust. And then we didn't have central banks. Then the governments would print money, and then we would go into an inflationary cycle, and the cycle would just start all over again. And we will, and that is how we build up debt. The debt crashes, and banks had a very volatile history. So what happened, we started experimenting in the 1600s already with central banking. This late 1700s, the Bank of England came, and then the Fed in 1930. And then we had the Depression in 1933, and then by 1944 we signed the Bretton Woods Agreement. And basically we've had an 80-year cycle of ever-growing inflation and debt. But just to get back to that point that I referred earlier to, that people think inflation is this wonderful tool to get rid of debt. Unfortunately not, because the deflationary cycles, they are unfortunately very bad for the economy. We tend to grow there's very low growth in that environment. But inflation, because it's this ultimate tax on society, and you tend to take then away the purchasing power of the poor part of the population, and they've got nothing to lose. Even something like the French Revolution was preceded by a banking crisis, because the France's finances in the early 1700s was in dire straits. There was a certain Scotsman by the name of John Law that arrived there. He started printing money. That led to the Mississippi bubble. He promised everyone, we will basically the same riches you'll make as the people made out of the Dutch East India spice routes. And in the meantime, he was selling them part of a swamp in Louisiana. So that eventually the banks crashed because of this scheme, and that led to a massive deflationary bust in France. Then they printed more money, and then as the purchasing power of money became a huge problem, the French Revolution broke out. So these things have a nasty tendency to end in a very bad way. So I don't know why people are so optimistic that inflation is our solution. But you can see clearly on the chart on the right in 1944, how the slope of asset returns, this is the real S&P, so it's adjusted for inflation. You can see all of a sudden in 1944, as we start getting out of as we get rid of the shackles of the gold standard, how the slope of the S&P started turning upwards, and the dividend yield started settling at a lower level. Now from 44 right through to 1988, the asset performance and the stock market and the asset performance as a whole and the GDP tracked each other. So that was perfect. So that was, in a sense, a good thing that we got rid of the gold standard. And then from 1980 onwards, then because we developed all these derivatives and a lot of others, and as we discussed already in depth in the previous presentation, all of a sudden assets started outperforming the GDP to the point that we have now this social, problems where the top 1% own virtually, half of all the assets in the world. But you can see how the dividend yield, especially from the 80s onwards, was going lower and lower. So eventually the dividend yield, when it gets closer to zero, it will be a problem, because if we go through the levels of debt, and therefore we rely on the work of Hyman Minsky, did a lot of research on debt in the 1950s. So you have three layers of debt. First one is transactional debt. There's nothing wrong with transactional debt. That's what we all use. You buy a house and a car with that, and the return on the asset is profitable to use it vis-a-vis the cost of that debt. Then you get speculative debt, and a perfect example of that is the development of the futures market since the 1980s. But that is typically where you'll take a loan, you never pay off the capital, you'll just service the interest on the capital. And then you get to, and when the asset yields so little, we start going to what he called Ponzi debt. So the only way to make money out of the asset is if you can catch a bigger fool paying you a higher multiple. So eventually, that's why there is an end game to this extend and pretend policies that the central banks have been playing over the last decade, although actually much older than that, started with Greenspan in '87. But there is unfortunately a limit because of the yield on assets. We already know bond yields are at zero. If we eventually take all assets to that they yield 0%, then we will be dealing with, unfortunately, a Ponzi scheme.
Thank you for that, Neels. So then now central banks cause this problem. I think in your paper you mentioned about 3 to 4 solutions, potential solutions that they could use. Can you quickly just run us through those 4 solutions?
Right. Well, I won't call them solutions, but I'll give it's the only 4 ways to get rid of debt. Is the first one, it's the one that is just, I'm not saying it's the most likely one. I'll mention it first because I want to discard it immediately. You can have a massive default on the system, and that people just decide not to pay back their debt. Now, that is not going to happen. The central banks is unlikely to allow a default cycle. That is what happened in 1929. So the crash wasn't the true cause of the depression. There was a bit of a layer in between. It was a banking crisis. So as the value of the collateral in the banking system crashed with the stock market crash of 1929, a lot of banks were in really deep trouble in America. Unfortunately, President Hoover, the president at that time, decided not to give a bailout to the banks. America lost 9,000 banks in the depression, and that caused the deflationary cycle. So I put a very, very low probability. Look, it is always possible that the stock markets crash and we have countries turning on each other, and that would happen. But I put a very low probability on that. So I want to discard a whole default and an insolvency cycle because of that. The second one is obviously you try and save out of the problem. Now, I put a very low probability on as well if we can be successful on that. If I can just ask to go to the next chart, please. Thank you very much. And this is the flow of funds, and I'll go into it in more detail now, why it's so difficult to save yourself out of over-indebted situation. Then the third one is you try and lift the GDP or your income. If it's on a personal level that you have to pay off your debt, you try and lift your income. And then when you have more income, your debt levels become more manageable and you pay off the debt. And then the fourth is the one that's getting the most attention right now, and hence all this interest and this debate regarding inflation or deflation, is you try and deflate the problem away. So you basically create inflation, money in a sense become worth less and less the whole time, and you pay off then the debt with worthless money. Now, unfortunately, as I remarked on that inflation-deflationary cycle, these massive inflationary cycles where you try and debase the debt, they tend to end in a pretty nasty way. So that is also not actually a perfect solution. But right now, that is what everyone is going for right now. There you can see how volatile it was in the past. So if we can just look on slide 2 again at the flow of funds, please. You'll see what happened in Japan. Now, Japan, the problems actually started way back in the 1950s already, and people don't realize it. The problem wasn't just the housing bubble and the property bubble of the 1980s. So everybody on the call most probably know that ridiculous statistic that at one stage they reckoned that the Emperor's Castle in Tokyo was worth more than the entire California. The one that I personally liked from that was one street block in the financial district in Tokyo was worth more than the entire Canada in property values. Now, we can say, what were they thinking? But the problem is we've got a few shares that's priced like that, like Tesla, that came down a lot lately, but it's worth more than all the other major car manufacturers together. So before we point fingers of what happened in Japan, we are busy doing exactly the same thing. But the big thing that happened is that blue line. You can see that in the 1980s, Japan's corporate sector, they were just saving and spending to the tune of 12% of GDP a year. And then, unfortunately, as the bubble burst, they had to restore their balance sheets, and they became savers. Literally over a very short period of time, they went from minus 12% to plus 12% of GDP, and they became massive savers to restore their balance sheets. Now you know why the Fed and all the other central banks, they are so aggressive when we have these setbacks like in COVID or during the 2008 crisis. Because they know, and that's why the Fed was trying to buy the corporate debt last year, just to make sure that you don't have this insolvency cycle starting in the corporate sector. And remember, before you have an insolvency cycle, you usually have a liquidity problem. So they try and stop it, that you don't even get to the liquidity crunch that will lead to the insolvency. They want to stop it as quickly as possible, that you don't get it to a situation where you have to restore these balance sheets. Because once you start to restore these balance sheets and everyone becomes a saver, Nobody saves, and that is the bizarre thing. We call it the paradox of thrift. If one person in the economy starts to save, we won't notice. But if everybody in the economy and all the sectors start saving at the same time, all that happens, the economy shrinks, disposable income shrinks, and it's not possible for anyone to save because you've got a falling income. This is not typical Keynesian economics, and this is what Keynes worked at in the 1930s, well, through the 20s, and then became very famous in the 1930 depression. He said, but then the government, and you can see there on the right, since 2008 already, the US, it's the gray bars below the line, the government becomes a bigger and bigger part of the of the economy. Just to remind everyone of the GDP equation, is consumption, C plus G is government spending plus FDI plus exports minus imports. So they try and boost the GDP equation by boosting the G part. That government becomes a bigger and bigger part of it. Now here it becomes quite tricky for America, and we'll get back to this on later, why I believe central banks need a bit of a steeper yield curve. You can see there when we had the commodity cycle, look at the black dotted line, when we had the commodities cycle in the early 2000s and stuff, before the 08 crisis, America, that black dotted line is the money America receives from foreign countries. And because America is the reserve currency and everybody buy dollar bonds as FX reserves, so in the commodity cycle, because we were generating so many dollars through global trade and the commodities boom and higher commodity prices, all that money ended back up in America. So in America, in a sense, then get forced to spend that money, and the US government was actually spending that money. So America, in that sense, is in a very difficult situation. It doesn't decide, in a sense, its own savings rate. It's getting forced upon him by the foreign investors. But that has been shrinking. So America now must run a bit of higher rates, in my opinion, to attract that money. Similar to South Africa, we've got this constant deficits that we're running, and we have to run higher real rates to attract the money. Because if they don't attract the money, they must save. And as I just explained, saving is the last thing you want in this over-indebted balance sheets, because we're trying to get the economy to pick up so we can repay all this debt in the world. But the moment we save, the economy will contract, and we're not going to be able to do that. So America's in a very, very difficult position. They're trying to create negative real rates so that we can debase this debt, but the negative real rates won't attract capital into America. And unfortunately, then the government has got no choice than to become the economy. That's why this MMT thing that's been building up over many years, and people also think this is some kind of silver bullet that you can spend yourself out of this. It is unfortunately not that likely, because the problem is with government debt, as a term we call crowding out, because the governments, they use all the available savings in the economy. They don't leave anything left. There's no savings left for the private sector. And governments are notoriously, through history, at allocating capital. So you get a bigger misallocation of capital. Look, the upside of that is they do get a bit of inflation out of it and nominal growth out of it. But over the long term, it's a drag on the economy. And as I pointed out, in history, that never ended in a nice way. So yeah, we're not going to save ourselves out of this. So let's, and it's going to be difficult to kickstart that economic growth. So let's look at the next option. If I can ask the next slide, is that we create then inflation, all right, to get out of this situation. So I just want to point out here as well, apologies, we will start getting to the inflation on the next slide. I actually forgot about this slide, apologies. So what is very crucial here, and in a sense it's a very, very, very good thing, because we're all fully aware of this tensions that are building up between the rich and the poor and the working classes all over the world. It's not unique to a certain country, it is everywhere. Workers are really unhappy because the red line, this is not America, but in most of the developed countries around the world, wages has been falling non-stop for 50 years as a percentage of global GDP. So there was a brief spike in the late 90s, and then again, as China came through, again there was a massive drop in wages again. Now that has been bottoming out and has actually been rising since the 2008 financial crisis. So, and as I said, also after the 08 crisis, America got less capital flows into America, so they've got no choice than to start saving internally that they can finance the deficits. Now, one victim so far of it, it just doesn't look like it if you look at the stock market, is that corporate profits as a percentage of GDP is actually falling. But because we have all this liquidity and there's super low rates and the compression of the term premium in the bond market, which has turned as a matter of fact, but that helped us to have massive multiple expansion. So the PE ratios just kept on climbing, and that's, we discussed that in the report as well. So you can't see it in the stock market quite yet, but corporate profits as a percentage of GDP is starting to fall as the wages are starting to pick up. Now, the green line, and I want you to ignore the spike, that is the personal savings rate. So the red is the wages, the green is the personal savings. So as I say, ignore the spike. It's now at 15% because the spike was the transfers, the COVID checks that people received, and the next lot is going out now. So, and a lot of people are very optimistic once all this money hit the market that the economy will be massive kickstarted of the financial sector. The balances in check accounts in America is already at $3 trillion. So a lot of money is already available for spending. So I think people might place a little bit too much optimism once the economy open up, that there will be this massive wave of spending coming through. There's a lot of money available already. But you can see there as well, the savings rate has been rising. And as I said, the last thing we need is a rising savings rate. And then if I just look at, forget the Maxillian spread is a fancy term for the spread between growth and GDP growth and the cost of capital. So in a perfect world where we don't have central banks interfering with the price of money, that should be very close to the zero line. So if the growth rate starts, if the growth rate settles well above the cost of capital, and I use the 1 year rate for that, then you know money is actually too cheap, and inevitably it leads to massive fallouts, and because money gets misallocated and you have big bear markets. And as the old saying goes, bear markets do not destroy capital, they merely point out that the money was misallocated in the first place. But the problem is that after every time, because we live in this highly indebted world with very, very leveraged balance sheets, so every time we have a financial crisis, and you can see it over history, the level of economic activity settles at a lower level. Now, we've been trying to fix this over the last 40 years by cutting rates to the point where it's the lowest in history, and it hasn't helped a lot to break that down cycle. And that's why a lot of people hope that inflation will do this for us. I'm very skeptical because inflation leads to lower productivity and all that stuff, and it's unlikely that inflation will trigger the growth cycle out of this. Okay, then we go to the liquidity. So as I pointed out, it's very hard to save yourself out of this. It's going to be equally as hard because the savings rate is going up. It's going to be very difficult to grow out of it. So now we've got to start looking at, can we print ourselves out of this situation? And if we can get the next slide, please. Right, so just to want to point out the first thing that happened is, and to remind people of what we discussed as well in the first program. So it was, QE is much older than the term QE. America ran these massive deficits after the fall of socialism in the late 1980s, and then they exported all their production to the East, to Asia and Eastern Europe, and then America imported that stuff and exported dollars. So that rising green line and the world's dollar monetary basis, the left-hand scale, went from 4 to 16%. And it was that absolute boost of the monetary base, and it grew by fourfold, that created this asset inflation that I referred to earlier, where assets just started outperforming the GDP because that money had to end up somewhere, because we had massive disinflationary shocks coming, and we'll come to that a bit later in the presentation, that came through the whole globalization and cheap labor and all that stuff. So as the commodity cycle turned in 2011 and started falling, we had very low asset returns around the world, because that constant fueling of liquidity into the system to keep asset prices going, that disappeared. And then as COVID hit, the Fed was fully aware that they had to turn the taps open as big as they can, because you can see they have at last got wages on the right-hand side, the dark green line on the right-hand chart. They got wages back up more or less to the GFC levels. And the last thing they could have afford is another major drop in wages, because that would just increase more the probability that you go into a deflationary cycle, and people will, and human behavior change, and you'll get a higher savings rate, and they know they have to stop it. So the Fed was very successful, and they literally ballooned the balance sheet from 13% to 18%, literally in 2 quarters. And that was the liquidity from the Fed pumping in. But as you know, it's not unique to the Fed. All the central banks printed a lot of money into the system. And if I can ask to go to the next slide, please. And there you can see on the right-hand side how all the central banks printed this money. So everybody talks about the Fed because they, the biggest central bank, they still are the most important because they run the biggest economy and they run the reserve currency. But by no means is the Fed the biggest balance sheet in the world. I mean, the Fed's balance sheet is in the region of 36% of GDP. You can see there the ECB is at 60% and Japan is at 133%. So all the countries were pumping money into the system. The reason why the dollar weakened so much, America was very successful in creating creating inflation expectations. And hence now this huge debate, are we going into inflation or deflation? Did they stop it? There is one major difference between 2008 and now. And yes, I do believe, because we haven't solved the original debt issue, and my big overriding secular view over the last 10 years has been, until we haven't solved the debt issue, I don't expect the next inflationary cycle. But the Fed did do something different here, and you can see all the central banks did it. It's the chart on the left. They, this time around, the central banks targeted the broad money, because they realized that all this expansion on the chart on the right since 2008 never ever went past the banking system, because central banks do not create money, contrary to popular opinion. They create what we call bank reserves. They put money into the banking system, and then the money multiplier must kick in, and we must lend that money out. And that never happened from 2008 to 2008, and the central banks, in a sense, created their own mess for themselves, because they flattened the yield curves to the point where the money multiplier wasn't working, because banks in theory make money out of the yield curve. We get rewarded for taking in money on the short end and lending out on the long end, and we get a yield pickup to reward us for the risk we're taking. And because they flattened the curve so much, and that's what went wrong, especially in the European banks, you didn't get that money multiplier and the velocity of money story you need to kickstart the economy and to avoid deflation. So the central banks this time, they went straight after that money multiplier, and they guaranteed the loans, the banks that they were writing. So 60% of loans that was written in America had a government guarantee on last year. So this has become a bit of a moral hazard, because now the central bank is no longer just there to supply the banking industry, is in a sense becoming the commercial banker. And time would tell if they're going to try and get their role smaller there, or will it become bigger? Because in a sense, if you go back and what went into Japan, that's actually what went wrong in Japan for the 1950s, 60s, and 70s, is that the Ministry of Finance used the Bank of Japan as a source of cheap credit to pump into the economy, and that actually led to the biggest misallocation of capital that eventually created the big problem Japan is facing today. Because believe it or not, Japan is in a sense a success story in that they never collapsed completely. They never allowed the debt to contract out of control, and that they had a crash like in 1929. So they have slowly but surely been debasing their corporate debt and everything over time as they were saving. But the problem is, as the deflationary cycles gets entrenched, you struggle to grow out of that. So yes, so eventually, if the central banks keep on targeting this M3, as we can see there on the chart, then there's a much higher probability that inflation would arrive, because they, between the helicopter money where they're sending these COVID checks, which is going out now as well, the $1,400, they've got a much higher chance of getting the money multiplier working and getting inflation. Well, I'm still a little bit skeptical of why it's going to work. As last year, there was a massive demand for liquidity, more than a demand for credit to grow the economy, because everybody knew we need liquidity to get through this lockdowns, and a lot of businesses realize they're going to have no income. So I first want to see if this growth in the M3 is sustainable in the second half of this year, before I'm be convinced that the central banks were very successful in creating inflation to debase the world's debt. Sorry for the very long explanation.
Like I said, you have a very deep well of knowledge and understanding. So with that, it sounds as though the fourth option, inflating the problem away, is the most ideal out of all of them. And that reminds me of an analogy that you and Mahul would use, which would be going for the cleanest dirty shirt. And with that, at what level of inflation do you think will this work? Does the central bank need to target like an absolute level where if we see that it is at an X level, we're like, okay, this is actually working? What are your thoughts around that?
Look, out of a trading point of view, a level that's very important for me is if you take the US 10-year break-even rate, and there's actually sort of a perfect trend line for all the tops on 2006, and that's currently sitting around 2.25. If the expected inflation starts breaking through that 2.25, and we're getting much higher expected inflation rates, then that will be the first sign for me, on more on a tactical basis, that the Fed is now successful to create inflation. But I don't think there's this magic level of inflation that will solve the problem. It's more a question of getting sustained inflation over a 10-year period, for instance, where you will have growth of 4 or 5%, and nominal growth. You will have nominal rates in the region. You will have inflation in the region of 4 or 5%, but you cap the nominal yields at 2%, and that is the next thing that's going to come out of this. If they start, if they are fortunate enough to create this inflation, these central banks, and because that's what they're trying to achieve, then they've got a problem, because the bond market is not going to sit still and roll over and play dead while the inflation pressures are building up in the system. We've seen just over the last few weeks how quickly the bond market could move if the inflationary concerns pick up. So that is going to, without a doubt, lead us to a world of repression, where the central banks then have to go out of their way to control the long-term interest rates.
With that, with regards to interest rates, how do then central banks ensure that debt service costs remain controllable?
You see, it's exactly that. That's where they're going to bring in this financial repression, in my opinion. So, I mean, everyone's guess is the first step they will take is this infamous yield curve control. It's something America tried, or not tried, they did it actually post the war, and there was yield curve control, I think, from 1947 up to 1951 or 52. And if I can recall correctly, they capped it at 1.6%. So the Fed would indicate, the Fed indicate to the Treasury, if there's an auction that comes out, the weekly auction, and it's 1.6% or above, they will take the auction and they will just monetize it. They'll print money and they'll take it the entire auction. Now, at that period, they never had to take it out because everybody in the market knows they've got to put to the Fed if it gets to 1.6%. So the market tend to buy before it gets to that point. Because unfortunately, yield curve control is a bit of a self-defeating operation, because you're printing money to keep bond yields down, but the more you print, the more the inflationary pressures you can build. But inevitably, I do believe that pre-scalp assets, and everybody hates that word, especially in South Africa, When I joined the markets in the 1980s, that's what we had to deal with. Just over 50% of all pension funds in the country had to be invested either in government or SOE bonds. So that the government, it was the latter part of the National Party, and that's how they funded then, obviously, the government at that stage.
Is this discussion all about the US, or are other central banks also heavily involved and impacted by the discussion?
No, so that is, we're all guilty of that. If we can just go to the next slide as well, please. We talk a lot about America because, and everybody has got a lot of interest in the FOMC, and as I said, because I set the base rate, and all bonds trade off the US bond. So we'll take the US bond as the base rate, and we build a lot of stuff on top of that to get to the fair value where the SA bonds must trade. So we tend to pay too much attention to just the Fed. But the problems the world is facing is actually global, all right? Because all the countries in the world have got too much debt. Now, one thing that is going to eventually get to the inflation is two charts I've got here, for instance. On the left is the Globalization Index. That's the green line, and you can see how all of a sudden accelerated in the early 90s after the fall of socialism, and the world just got far more integrated. That has been topping out, and the annual change, as you can see now, sits on 0. So globalization is starting, to slow down, and it's not in reverse quite yet. But I do believe that nationalism is on the increase, and the president has just been outspoken about that. But I think it's a trend, and we're not going to stop it. People were very shocked in the COVID crisis that they didn't have access to the medicine, and you're now very dependent on other countries. And obviously, we all know about the pressures building up in the semiconductor space and when it comes to defense. And then also what eventually will add to the inflationary cycles, and that's also now a global problem. It's just a little bit more severe in the developed world, where your dependency ratio is turning up. Now that is basically the ratio of the pool of workers you have available vis-a-vis people, that's a chart on the right there, vis-a-vis the people below 15 or over 65. Now why the pool is shrinking is not that unfortunately that the group of people at the 15 is growing. It is because the group of people over 65 is growing. The world is starting to get old, and this demographics will lead eventually to inflationary pressures as well, and labor, that as I pointed out over this entire cycle, labor never had any pricing power, and the productivity gain that came out of this unfortunately went into asset prices and not to labor, but that we discussed already. But so a lot of people have sent me these charts and said, but this is inflationary, it's coming. So this is like calling deflation in 1968 when this rolled over. It took us 40, 50 years to realize that we are dealing, and in my entire lifetime in the bond markets, we had falling interest rates, and we were looking for inflation behind every single bush every time. So I think it's completely premature to start calling the inflationary cycle, well, this is bottoming out, as I say, it's like calling deflation in 1950. There was an awful lot of inflation before we started getting into the disinflationary cycle in the late 1980s. But no, the debt, I mean, China sits with the highest corporate debt in the world. They are very vulnerable. They're becoming more and more vulnerable because when China was a closed economy, they were sort of buffered from a lot of these global shocks. But because there's so much liquidity flowing into China now, because of all this liquidity the central banks are pumping into the system, they had to open up their capital account, and they are becoming exposed to this. So I actually want to stop it here, and that we can try and face some questions. I know if already this carried on too long, apologies.
Before we get to the question, I think this is something that's important that we address, where I think these trends that you are talking about, they're very big trends that have developed over the last few decades. So then how do we then monitor all of these developments in the market in real time so that we're able to understand what is happening?
Thank you for that, Ruth. So the dollar. I mean, the dollar has been for the last 30, 40 years, and it will going forward until the dollar eventually loses its status as the reserve currency. And the day we stop, trading in dollars in global trade, most transactions still today is settled in dollars and everything. So the dollar is the real-time barometer to indicate whether the money supply is ballooning or whether it's contracting. If the dollar, because there has now been inflationary fears building up since the second quarter last year, the dollar has been in a massive bear market because of that. So the very, very important level to monitor, that's very similar to that 2.25 I'm watching on the break-even rate, the expected inflation. The very important level on the dollar is 88. So that, in my opinion, is the best barometer of all these trends that we explain, because it's very, very complicated. But the best summary of all of that is the value of the dollar.
Okay, so the question that we have, it's in relation to inflation, where it says, how is bond issuance impacting US inflation expectations? So government is issuing loads of nominals but no tips, which is affecting the implied inflation number.
Yeah, that is something where the Fed has lately distorted a bit of the inflation expectations. It's not on one of these slides because the Fed has started buying a lot of the tips. So it's difficult to read into the tips what the inflation forecast is. So that is 100% correct. That statement, whoever asked the question, is that it is getting a bit distorted. But the issuance per se doesn't change the level of interest rates that much. Japan is a perfect example. I mean, their government debt to GDP is in excess of 250%, and yet the interest rates are very low. All right, granted, they are buying most of that bonds, and I actually think, as I indicated, that's going to happen. It's already happening in the rest of the world, and if the central banks run out of ammunition, they're going to force the asset managers and the pension funds to buy it. So I don't foresee that the supply of bonds will change the level of interest rates that much. Yes, it can change the slope of the yield curve, which happened, the 30, 10-year changed dramatically over the last year or two already. It's steepened a lot. It's actually coming in lately. So yes, it changes those things and the inflation forecast if they get involved in the tips. But I don't believe at this stage it will have a massive influence as much on the level of interest rates. As a matter of fact, I do believe the central banks need a bit of a steeper curve. They need interest rates for the savings. They need a steeper curve for the banks. America needs to attract money, and they have allowed the term premium to rise up, which is lifting the volatility, which is helping with the financial stability concerns they have.
Unfortunately, we have run out of time, but let me quickly take one more question where, so it reads as follows. Neels, no doubt it is a stimulus and business support. It is a stimulus and business support that has increased broad money supply, something that QE and rate cuts has failed to do for years. Do you then expect the Fed and more correctly the US Treasury to keep the stimulus support until they have achieved their inflation targets, even after COVID is long gone?
The short answer is yes.
Okay, and then I guess we have time for another one. Quickly, what does this mean for equity and bond markets in your view, if your view holds true?
So yes, I do believe that if we, my view, and that's what we wrote in the document, I do believe we'll get closer to 2% on the US 10-year as the inflation pressures build up through this first half of the year because of base effects and everything from last year. But closer to 2%, I will rather take an overweight bond position and downweight the equity position. In the equity market as well, I think the real rates will start rising as we get closer to 2%. And then the growth stock theme that we've had, well, since 2008, but especially also since COVID last year, because then, unfortunately, as the real rates rise, I think the growth story will come under pressure, and the rotation out of growth stocks into value stocks will pick up more and more momentum as well.
Thank you so much for that, Neels. Unfortunately, we have come to the end of today's segment, and how I'm going to close it off is I'm going to ask Neels to do something that I think will be extremely difficult for him. Where can you close off by literally give like 2 sentences that people can walk away from our series, like literally 2 sentences.
No, as I say, we are at very, very crucial levels. The dollar is weakening again. The stuff I would look at is the expected inflation and the dollar. If the central banks are successful in creating inflation, it will come through now. If we do not break much weaker through the 88 on the dollar, and we do not break substantially above this 2.25 on the break-even yield. If this kind of stimulus do not create the outcome they want, the deflationary forces are going to be here for much longer than people want.
Thank you so much, Neels. I'd encourage you guys to go read the paper if you haven't. I think some of the questions that are on there probably addressed in the paper. With that, thank you so much, everyone, for joining us. I do hope that you did enjoy our series. If you have any other questions that might come up post this, I think feel free to pop Neels an email or give him a call. I'm sure he'd be happy to discuss whatever thoughts you have after reading the paper. And yeah, that's it from us today. Enjoy the rest of your afternoon.